Hello guys. So the next topic that we will start off is the cash flow statement. So cash flow statement, by the way, is one of the most interesting topics in the syllabus. Particularly I find it very interesting, and it is something that one should notice while looking at the financial statements that we've seen up till now. So let me begin with this example just to give a brief background. So let's say there's a company called Alt Limited. Now, they have shown in their income statement that the profit for the year ended December 21 was 500,000. Now, if you're an investor or any other analyst who's just trying to focus on the company, and after looking at this figure, when you look at the company's cash and cash equivalent in the statement of financial position, you can notice that last year the company had 150,000, but this year the company is currently running an overdraft. Now, if let's say you have no knowledge of accounting previously, but you do want to go through the books at least, the first thing that should cross your mind is that if the company made a profit of 500,000, how come it is now running into an overdraft from a positive balance last year? 500,000 would mean that the bank balance or cash and cash equivalent should have also increased by 500,000. So there is some level of confusion over here. And the obvious reason to that is that this profit figure is based on something called accrual accounting, which I will discuss very soon. This does not give an indication of the movement of cash. So, an income statement which shows the profitability for the business and statement of financial position which shows the financial position of the business at a particular date is not sufficient to explain all angles of a business. So, limited companies therefore are required to add one more financial statement that will help overcome this problem. So, the fourth financial statement that we should add over here is called the cash flow statement. What the cash flow statement will do is it will show the inflows and outflows of cash and cash equivalent. That one question that is missing. So, how come in our example, despite a profit, the company was running in an overdraft? You guys should know the obvious reasons could be that maybe the company bought a new non-current asset. The company had to repay a particular loan, right? So the suppliers were unpaid last year. Their outstanding had to be cleared off this year. So there was some movement of cash which cannot be explained through the income statement and the statement of financial position. That will be explained by the cash flow statement over here. That's the reason why limited companies are also required to prepare cash flow statement to show the movement of cash. So we can now say that the cash flow statement shows the inflows and outflows of cash during the particular year and can be used to assess the ability of the company to generate cash it requires. Alright, so how did the cash move around? How much cash does the company generate? Where is the cash going? All these questions will be answered through the cash flow statement. And therefore, the cash flow statement will contain information that is not included in the statement of financial position and the income statement. And it will also give you a link between the cash balance at the start of the year and the cash balance at the end of the year. This will help answer the questions that an investor or an analyst might need to understand where did the cash go despite making a profit. But do we really need to have the cash flow statement? Why is it necessary? Why cannot the income statement and the statement of financial position actually help us to explain the movement of cash? So why is this need? So as I mentioned earlier, the reason why we come across this need is that the income statement that we have learned to prepare up till now is based on accrual accounting, right? So accrual accounting also includes non-cash revenues or expenses, and it's focused more on that when does the company earn revenue rather than receiving money, and when does a company incur expenditure rather than making a payment. So accrual accounting, which was also covered in matching concept, is the reason why we need to have a separate cash flow statement to help us explain the movement of cash. Let me explain it like this. So there are two ways how you can draw your income statement up. You can either follow the cash method or you can follow the accrual method. Under the cash method, you will recognize revenue only when cash is received. So when your customer will pay you, that will be recognized as a revenue. and expenses will only be recorded when cash is paid. So if you pay for electricity, that's only when you can record it as an expense. But what we follow up till now is called the accrual method. Under the accrual method, we record revenue when it is earned rather than cash being received. So if we sell goods to a customer, that will be recorded as a revenue. Whereas expenses will be recorded when they're incurred over here. Right? That's the cash method, that's the accrual method. Now, how would life be if we were following the cash method? So our life would be something like this. So this profit figure from the income statement will be the same as the cash flow statement figure. So as a result, I don't need the cash flow statement if I'm following the cash method. Everything should be covered in the income statement profit figure under the cash method, right? That's how easy our life would be. But obviously life is not easy. What we follow is called the accrual method. So under the accrual method, this profit and loss figure will not be the same as the net cash flow because profit is different from cash, right? Profit is recording income being earned and expense being incurred, whereas the cash shows the movement in cash, which is why under the accrual method, there is a need to prepare the cash flow statement. Therefore, the cash flow statement has to be prepared by the company because it measures the health of an organization, that how much cash was generated, where did the cash go, which is why we learn how to prepare the cash flow statement as well, which is again a mandatory requirement for your limited companies. Right? So the cash flow statement, what we've learned up till now, will show the sources of cash. Where did the cash come in? It will also show where did the cash go. It can explain reasons why there is a bank overdraft, something that we cannot just understand from the income statement. To the users and analysts, it will help you show the movement of cash. So, for example, think of it like this. If a company is spending too much money in paying off expenses, then an investor or analyst should be cautious because they will know that every year they will have to spend this much cash and will not have sufficient cash to maybe reinvest in the business. But let's say if the company is spending cash in a particular year on buying new non-current assets, so you would know that in the future these non-current assets will help you generate more sales, they will help you generate more profits, it will help you generate more cash, which will give a long-term benefit. So the movement of cash has to be traced, that where did the cash go during a particular year. And it can also help you predict your future cash flows, which is also required for valuation perspectives. Yeah. Finally, you would want to assess the liquidity of the business to judge the cost of profits as well, because one thing we should take a note of is that cash flow statement will be much more objective than the income statement. The reason for that is that the profit figure will contain subjective items, something that we will not find in cash. What can be the subjective items? They can be depreciation, that's something that companies will determine by themselves. Provision for doubtful debt, again a subjective item. So cash flow statement will be much more objective, or cash will be much more objective, and it will not be subject to any accounting policy. And it can help you give an assessment of the solvency of a business. Right, so the basic idea that we served in this video was we had to understand why do limited companies need to prepare cash flow statement despite having an income statement and statement of financial position. And the obvious answer to that is that the movement of cash can only be traced by preparing a cash flow statement, which everyone would want to know as it determines the health of the organization.